Welcome back to the Daily Crypto Roundup. Bitcoin is back above $61,000. The market has finally been given a bit of breathing room, and today's crypto rally is not coming from one single story. It is coming from three things lining up at once: weaker US jobs data, falling oil prices, and the growing belief that the worst of the recent crypto shakeout may now be close to running its course. And that matters, because for the last few weeks, the market has felt like it has been trapped. Bitcoin has been under pressure, altcoins have been battered, strategy-linked stocks have been questioned, ETF flows have looked nervous, and traders have been wondering whether this was just another dip or the beginning of something much uglier. But today, the tone is different. Bitcoin is trading around $61,000 to $62,000. Ethereum is around $1,700. XRP is around $1.09. BNB is around $560. Solana is back near $80, and Hyperliquid is holding around the mid-$60 range. That is not a full recovery yet, and we should not pretend it is. But after the market recently broke below key levels and sentiment got extremely negative, this bounce is important. Before we go any further, this episode is brought to you by Kraken. Not financial advice, but if you are looking for a trusted place to buy, sell, and manage your crypto, check out Kraken through our link. It helps support the show, it helps us keep doing these daily episodes, and remember, we are still giving away 20 XRP to listeners who sign up using our link. So thank you to everyone who has already signed up. And if you have not yet, the Kraken link is in the description. Now, the biggest story today is the US jobs report. The American economy added only 57,000 jobs in June. Economists had been expecting around 110,000. May was also revised lower, from the original 172,000 figure down to 129,000. So the message from the labor market is pretty clear. Hiring has slowed sharply. On its own, weaker jobs data would normally raise fears about the economy. But for Bitcoin and risk assets, the market's first reaction was actually positive. Why? Because the Federal Reserve has been the biggest pressure point. If the economy stays too hot, the Fed has more cover to keep rates higher or even raise them again. Higher rates are normally bad for crypto because they tighten liquidity, strengthen the dollar, and make investors less willing to take risk. But if the jobs market is cooling, the Fed suddenly has less room to be aggressive. That is why traders immediately started dialing back expectations of a rate hike. This is the same macro game we have been talking about for months. Bitcoin is not just trading on crypto headlines anymore. It is trading like a global liquidity asset. When markets believe the Fed is getting more hawkish, Bitcoin struggles. When markets believe the Fed may have to soften, Bitcoin catches a bid. That is exactly what happened today. Bitcoin had already been moving higher before the data came out, but the weaker payrolls number gave the rally a reason to continue. It pushed Bitcoin back above $61,000, briefly above $62,000, and it helped lift the wider market with it. But this is where we need to stay balanced. A soft jobs report is good for rate expectations, but it is not automatically good if the economy starts looking properly weak. There is a difference between the labor market is cooling enough for the Fed to ease off, and the economy is rolling over. Right now, the market is treating it as the first one. That is why crypto is rallying. But if future data starts screaming recession, that would be a very different conversation. The second major story is oil. Oil has dropped to a 125-day low after signs of progress in US-Iran talks. West Texas Intermediate fell to around $67 a barrel, while Brent crude dropped towards $70. That is a massive change from May when oil was trading above $100. This is a big deal for crypto because energy prices feed into inflation. If oil is rising, inflation pressure rises with it, and the Fed has more reason to stay tough. If oil falls, inflation pressure eases, and the market starts to believe the Fed can back away from the edge. So today, crypto got a double boost. Jobs cooled, which weakened the case for rate hikes. Oil fell, which weakened the inflation threat. Put those two together and you get a much more supportive backdrop for Bitcoin. The Iran talks are not finished. There is no final agreement yet. But the fact that both sides are expected to continue negotiations has given markets a window of calm. And sometimes that is all risk assets need. They do not need the world to be perfect. They just need the worst-case scenario to move slightly further away. For Bitcoin, the technical level now being watched is around $62,500. That area matters because it lines up with a descending trend line and a major retracement level from the recent sell-off. In simple terms, if Bitcoin can break cleanly above that zone and hold it, the market can start to argue that the recent downtrend is being challenged. If it fails there, then this may just be another relief bounce inside the same corrective structure. That is the short-term battleground. But the more interesting story might be what is happening around Strategy, MSTR, and STRC. Bitwise has come out and said the recent STRC sell-off does not look like Strategy's breaking point. Instead, they argue it looks like the kind of leverage unwind you often see near the late stages of a crypto cycle. That is a very important distinction. STRC, Strategy's preferred stock, had fallen sharply away from its intended $100 level. That spooked the market because people started asking whether Strategy might be forced into selling Bitcoin, whether the capital structure was under stress, and whether Michael Saylor's entire Bitcoin machine was becoming a risk to the market rather than a support. Bitwise does not see it that way. Their view is that Strategy remains well capitalized, with tens of billions in liquid assets against a much smaller debt pile. They also argue that the volatility in STRC is part of the market flushing out excess leverage. In other words, the pain is real, but it may also be part of the bottoming process. Matt Hugin from Bitwise said he thinks we are nearing the bottom. Now, nobody can call the exact bottom. That is impossible. But the point he is making is that when speculative structures start breaking, when leveraged products start getting repriced, and when panic starts spreading through the riskier corners of the market, that is often when the cycle is doing the ugly work it needs to do. That does not mean everything instantly goes up. It means the market may be cleaning itself out. Strategy has also changed the way it manages its capital. It now has a framework that could allow selective Bitcoin sales to fund preferred dividends, while also allowing preferred share repurchases and buybacks. Some people see that as a risk because it means Strategy is no longer just a one-way Bitcoin buyer. JP Morgan has argued that this creates two-way risk and could add uncertainty. But Bitwise's counterargument is that Strategy is evolving from a pure accumulation vehicle into a more flexible capital allocator. And over time, they believe institutional investors, asset managers, banks, pensions, endowments, and sovereign funds could replace Strategy as the dominant source of Bitcoin demand. That is a massive shift if it plays out. Because for years, Saylor has been one of the biggest Bitcoin buyers in the world. But the next cycle may not be driven by one company. It may be driven by institutions, ETFs, pensions, treasury products, and regulated investment vehicles. That would be a healthier structure because Bitcoin demand would be spread across a much wider base. Saylor, meanwhile, is still leaning straight into the chaos. He highlighted that MSTR's open interest to market cap ratio has climbed to almost 72%. That is miles above major tech stocks. Tesla was around 16%, Meta around 11%, Microsoft just over 6%, Nvidia below 6%, Amazon around 4%, Alphabet around 4%, and Apple just above 3%. What does that mean in plain English? It means there is an enormous amount of derivatives activity around MSTR relative to the company's size. Traders are all over it. Some are betting on a rebound. Some are betting against it. But either way, the stock has become one of the most heavily contested names in the entire market. MSTR also bounced back above $100 today after recently falling towards the low 80s. That move came alongside Bitcoin's recovery, and it lifted other crypto-related stocks as well, including Coinbase, Robinhood, Marathon Digital, Hut 8, and Bitcoin ETF-linked exposure. So again, the message is not that all the risk has disappeared. It has not. The message is that the panic has cooled. And some major players are now arguing that the recent stress may be closer to capitulation than collapse. Then we have eToro, which is another story that says something much bigger about where this industry is going. eToro has led a $12.5 million funding round into Extended, an on-chain perpetual futures exchange built by former Revolut employees. The plan is to integrate Extended's perpetual futures engine into Zengo, the self-custody wallet that eToro acquired earlier this year. This is not just another funding round. This is part of a much bigger race. Traditional brokerages, crypto exchanges, DeFi platforms, prediction markets, and tokenized asset platforms are all starting to crash into each other. Robinhood is building more on-chain products. Coinbase has moved deeper into derivatives. Kalshi is moving into perpetual futures. eToro now wants DeFi products inside its ecosystem. And Extended has already processed hundreds of billions in trading volume while supporting more than 100 perpetual markets. The direction of travel is obvious. The future of trading is moving towards 24/7 markets, tokenized assets, on-chain derivatives, self-custody, and platforms that blur the line between stocks, crypto, commodities, prediction markets, and real-world assets. That is why this story matters. It is not about eToro alone. It is about the entire financial system slowly being rebuilt on crypto rails. And this is where today's roundup ties together. On the surface, the market is bouncing because Bitcoin got above $61,000 and the jobs report came in weak. But underneath that, there is a bigger story developing. Macro pressure is easing. Oil is falling. Rate hike expectations are cooling. Strategy panic is being reframed as a possible late-cycle deleveraging event. Institutions are being positioned as the next major Bitcoin buyers. And traditional brokerages are racing to bring DeFi products to mainstream users. That does not mean we are instantly back in a bull market. It does not mean the pain is over. Bitcoin still needs to prove itself around $62,500. The market still needs follow-through. The Fed still matters. Iran talks could still break down, and Strategy's capital structure will remain under the microscope. But today was the first day in a while where the market had a proper narrative to build around. The bears wanted a breakdown. Instead, Bitcoin reclaimed $60,000. The macro crowd wanted hot data. Instead, jobs cooled. The inflation hawks wanted pressure from oil. Instead, oil broke lower. The strategy panic crowd wanted forced selling fear. Instead, Bitwise argued this may be part of the bottoming process. So the mood has changed. The next question is whether Bitcoin can turn this bounce into a confirmed reversal. If it can break above resistance, hold above $62,500, and keep building while liquidity expectations improve, then the second half of the year could look very different from the first half. For now, stay calm, stay sharp, and do not get shaken out by every red candle or carried away by every green one. The market is still dangerous, but it is also starting to show signs of life. And as always, we will see you at the top.